Hey everybody, this is Jose Blasco. We are about to get started. Let's have a quick sound check as we always do. Quick message on the chat box, please. So I know you hear me and sound is good and we are ready to get started. We got like 15 seconds to go, something like that. Quick hello, please. That would be great. It's always nice. And that way I know sound is good. Wonderful. Thank you so much, Mark. This is great. It's appreciated. Thank you so much. That's it. Time to get started, everybody. So welcome to the session, everyone. Today is May-15, 2022. This is our top session. We often run top sessions over the weekend, typically on the Sunday, if you're in the US. Using New York as a reference. Normally, that's how we set our schedule. And my name is Jose Blasco. Not sure I said that one. You have the email on the screen. If you need anything, obviously, apart from interacting with me in the session live, which is ideal, you can certainly connect with me using my email address, apart from the question page, which I will show in a moment. Before we get started, I wanted to highlight the financial disclaimer. So please read it carefully. This is important information. We kept it relatively short, so you can read it completely, and I'm counting on you to do that because, as said, it's important information. Thank you for that. Jeff, how are you? Good to see you, my friend. Very nice. So, agenda for today, we're going to be spending some time on the platform. Often when we talk about top, we'll often combine the use of the software together with lectures that have to do with trading. It could be trading any asset, or many times a bit more specifically related to options, since top is a platform which is applicable to all assets, but definitely specialized in options trading. So we'll do that today, and it will be a powerful session for you guys, within the series of top sessions that we are doing. Hopefully this one also will count as a powerful one. Today my plan is to complete the matrix, okay, which is the tool that we use to research opportunities real time. We have been looking at it for a few sessions now, and I believe that today we should be able to complete that discovery of the matrix with the remaining filtering tools that we haven't covered yet. Okay, so that would be the plan. Also, very quick before we get started, I am pointing at the question page that I mentioned briefly earlier. So the URL to get to this page is tradewithufos.com/Jose. When you come to this page, you scroll down, and all the way at the bottom part of the page, this is where you can search for answers, because there are many questions here posted for a long time, or click on the green button to ask your own questions and therefore get answers to topics that are not part of the list yet. Okay, and by the way, you can also interact and participate of prior questions and answers, because this is a forum style type of section where, of course, our support team is always on top of things, so you get the answers, but also anyone is welcome to participate. You just need to log in. Okay, that's all you need. You don't even need to be, if you're watching this, let's say on the YouTube channel, for example, and you're watching this delayed on the YouTube channel because you attend this for free instead of real time on our page. Well, while you are not attending this is real time, you are still entitled to post questions and get answers from the support team. Okay, so I guess it's powerful and useful for everybody. With that said, I am now moving back to top, and I am about to load. Not sure what I'm doing here. I just wanted to click on the matrix button. So I was saying that I'm about to load the matrix. So here's the matrix. I'm just going to float it, so that way we can see a little bit of a larger matrix, if you wish. I'm just going to make it a bit larger just on purpose, so it takes most of the screen. So that way, you guys can focus on that. I'm going to link it to be blue color. So that way, when I change things on the matrix, it would also change on the charts. Actually, look, not to mess up with my current charts, I'm going to make it yellow. And I will also load a chart, and I will make it yellow too. And I will maximize it. So that way, whatever I find in the matrix, I will then come and assess it with the charts. Okay, so here's my matrix, yellow color, and below I have the yellow color linked chart. Good. Okay, so we've been looking at many things inside the matrix. The last series of sessions that we had were exploring the different types of scans that are ready to be used. And the last ones that we covered were the weekly bearish candlesticks. Okay, we have covered from top to bottom from top to bottom all the way to weekly bearish candlesticks. Okay, so today I'm going to continue with reversal signals, and we're going to go from there. And as I said at the beginning, I believe that today I'm going to be able to cover the rest of the scans, and we'll call it a day when we get there. In the meantime, of course, if you have questions, feel free to ask. If the questions are not exactly related to what I'm doing, it's okay. You can still ask, and maybe I'll give you the answers at the end or something like that. But for sure, happy to support you in anything you need, apart from the very specific topic today when it comes to the matrix. Okay, good. So let's go for it. So reversal signals, what is that? Well, as the name suggests, it's a filtering condition that is basically providing a series of opportunities that potentially represent the market changing direction. Now, of course, the market reversing or changing direction is something that could be measured or seen in so many different ways, and therefore we have a list of options here, which is quite long, to be honest. Now, within this list, there are kind of like two groups. So the group on the top, from here all the way to here, okay, from here all the way to here, they kind of represent reversal signals based on the current price action, no matter what that price is. Okay, no matter how high or low price is, given the price action, those reversal signals are implying or potentially pointing at opportunities that suggest the market is reversing. Where the two cases below, those are special cases, the speed bumps of resistance and support. Those, they don't represent any reversal signal based on what the price of that market is doing now, but based on where the price is. Okay, so when price went very low, and we'll see in a moment what is that low. So because price is very low, now it's supposed to go higher. Or when price went very high, and we need to see what's very high. So when price went that high, now it's supposed to reverse and go lower. Okay, so in other words, the two signals below have to do with location of price, where is the price, how much is the cost of that stock, for example. Where the indications above, one more time, have to do with the price action, what is happening at this moment in time. So now, because of those two comments I just made, so next thing you know, you could envision two different, there are many, more than two, but two main groups of intentions or needs for utilizing this type of filter. Okay, for example, you may be looking for a stock that is very strong, that belongs to a strong sector, with an Elliott wave turning point, blah 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 blah, where all of these could be done utilizing the additional filters that are here below, which we covered in prior sessions. And now that you got all of that, maybe you want to add more evidence that shows that, okay, so all of this is true, the stock is strong, it belongs to a strong sector, blah blah blah, but on top of that, I want to see the price action showing that this market is now, showing me a 3-bar reversal up, for example. Okay, so this now could be seen as kind of like a confirmation that you got a market condition that suggests the market is going to do a certain thing, and now you have actually price action to kind of confirm that's happening. So this is option number one, if you wish, on how to use that scan. Okay, so you can filter based on any other conditions that we covered before, and then add, for example, a 3-bar reversal up. Okay, and just to show you how it looks on the chart. So, for example, if I was to pick ABB, for example, and I go back to the chart, so notice how out of the last 3 candles, okay, so if we look at the last 3 candles, okay, so the current close of this candle is above the high of the last 3 candles, and therefore this could be seen as a reversal up, because the only way the current candle is closing above the highest high of the prior 3 candles, it's because price moved up. Okay, so now you have a little bit of an evidence of price action, which again, if you were to add here certain conditions, which I'm not going to do because we covered that in prior session, but if you were to add other conditions such as strength, group, etc., so now you are using this reversal signal as a confirmation type of tool. And of course, depending if you are more conservative or less, so maybe you are less conservative, so instead of simply 3-bar reversal up, maybe you just go for the warning. So what is the warning? Well, you'll see, for example, if I look at AA, so the warning is that price was trading above the the highest high of the last 3 candles. There was a moment in time where price was trading above, but the close is actually not above. Okay, so price is telling you I want to go there, but it didn't close there. So it's a warning. It's not a full confirmation based on, if you wish, the terminology used in this particular type of scan. Okay, so you can be more conservative and go for up, less conservative, go for warning, maybe even less conservative and you are looking at 2 bars instead of 3. Maybe you want to look at 5 bars. Maybe you only care about what happened in the last 2 days. So you look at the bar high to be greater than the high from yesterday. So again, for example, AAP, when you look at that, so you would have the close is higher than the yesterday close. Okay, so now you're looking at only 2 bars. Again, I guess you get the point. Okay, so you can be more conservative, less conservative, and I guess that you having you use these signals or not would depend on you spending a little bit of time looking at the results, looking at what matches your trading plan, what makes you more comfortable, which is very much in line with how conservative you are and how much more evidence you want to get. The more evidence you get, like 5 bars instead of 2, for example, in a way it's good. In a way, it makes you very late to the party. The price may have to move a lot to the upside to be above the highest high of the last 5 bars versus the highest high of the last 2 bars, and therefore you may be late to the party, even though you have more evidence. So pros and cons, and there is no right or wrong. It's for you to play with and decide, given your trading plans. Okay, so all of those conditions of reversal signals have to do with this type of market behavior. We are looking at price action, which is doing a certain thing, and that certain thing basically is giving you a sort of a confirmation that this is happening. The other case, which are the 2 cases below, have to do with the speed bumps. Okay, and the speed bumps, if you have attended prior sessions, you know what they are. In case you haven't, let me plot the speed bumps on the screen so I make sure that everybody understand what we're talking about. So the speed bumps is when you come here to the chart and you click on the this icon with kind of like 3 lines, and you pick a key or easy to spot pivot low, and you click on it, and automatically it's gonna project what's called a speed bump. Okay, and out of that speed bump area, we are supposed or expecting a price to turn and move in the opposite direction. Of course, this is not going to happen every single time, but it happens quite often. So in this case, I'm pointing at a key pivot high. So when I click on it, you can see in this case, price went through and did not react well. Okay. In this case, we are clicking and pointing at another pivot high. And in this case, it did work very well. Price went exactly where the pivot was and dropped intensively from there. So again, the expectation out of those speed bumps is significant turning points. We're not expecting a little bit of a turning point like that and that's it. We're expecting major movements either up or down that are originated often from those speed bump areas. So in this case, we don't care too much about what price action is taking place here or why price action is taking place there. We just care about the fact that price is inside. Whenever price is inside, that's when the matrix is going to cheat that information to you. So then you can go ahead and consider executing a trade or not, which of course you can filter out further based on other conditions. So for example, in this case, I'm going to look at reversal signals. I'm going to look for supports, for example. So supports, and for example, we got AA. So I'm going to look at AA. And if I was to look at the prior significant pivot low and draw a speed bump, well, to be honest, this is not the favorite type of speed bump I would want to use because that speed bump was not fully respected at some moment in time. But what the filter is doing, it's really not doing that. But what the filter is doing is showing you that the current location is inside the speed bump. That's what the matrix is doing, and therefore your filtering condition is met, and therefore you are being alerted. Okay, now of course I would understand if you were to not to accept this trade because of what I just said, and therefore you were to look at the next one. So let's take a look at the next one. Maybe the next one is better. So I am guessing that maybe the next one is coming from here. Yes, where we have this price condition met, okay, where the current price within the trading candle, okay, was inside the speed bump, okay, inside that price zone. Even though the speed bump is not drawn all the way to the right because this is an old pivot, the price level within that candle was inside the speed bump, and therefore from there we expect this significant turning point to take place. Okay, let's pick another example. See if we can have something a bit more kind of like book type of example. So not sure this is going to be a book example or not, but let's try. Okay, so same story. In this case, the speed bump was slightly violated, but again, during the last trading candle, there was a moment in time where we were inside this price range, and therefore we were alerted. Okay, again, if you are watching this recorded long time from now, you may be wondering how come many speed bumps are violated before they are reported by the metric. Well, it has to do with the fact that in the prior few days, if you're watching this live with me today, in the prior few days, the market has been extremely violent to the downside, and therefore there's been very strong movements to the downside. But now again, price is coming back up, and we are lining up with that pivot area. Speed bump area. Which, by the way, the way the matrix is going to find them is by looking at the last relevant pivot, which is right here. Okay, because you can find speed bumps from other pivots. Okay, but the one the matrix is looking at is the last one. The last one meaning the nearest one to the current date. Okay, that one on the left is further away, is older, so that one would be ignored. We're only looking at the nearest one. That's what the matrix is doing. So let's look at one more example, just in case. So AB. Okay? So with AB, so you can see the nearest one is here. So if I was to plot the speed bump, okay, so same story. It was, challenged here because of the very violent movement in the market, but in the last trading candle we were inside. Okay, so again, maybe not the neatest examples. Let's take a look at speed bumps of resistance. Okay, let's see. We should have much less, of course. Here we go. The market has been very violent to the downside. Therefore, few markets are trading inside speed bumps with sell orders. Okay, but in this case, again, if we were to look at that one here, I guess, is the one that is being spotted. Okay, so we are inside. Okay, which again, in this case, it was violated to the upside. I guess it's Murphy's law. Let's see if we can find another example. CERN. Okay. Okay, so I guess it's going to be the same. If I look at this one, because it's looking at the one that is nearest in price, but which is below price, because this one above is, of course, it's going to project a pivot much higher. So that one is not counting at the moment. We are talking about being inside this one. Okay, this one, you could say it's fine. It was just a little bit of a, challenge, but very, very mildly. Okay, so again, this is very useful because in this case, we are not looking at price action already moving lower. We are actually looking at where is price. So now you could turn on your UFOs in a lower time frame, plan on a counter trend trade, things of that sort, knowing that if the speed bump produces what the speed bump is supposed to produce, which happens quite often, as you will see and you have seen, you could anticipate and catch those relevant market movements right from the beginning. That's the beauty. At the same time, the downside is that you are expecting something to happen that has not started yet. You are just trading or planning to trade based on a price location, which again, by itself is not strong enough. So you will need to add other conditions in your trading plan to make this stronger. For example, the use of the UFOs, the use of a sector, etc., etc. Okay, I want to extend it in this conversation not to make our session too long today, but hopefully you get my point. The last comment I'll make about reversal signals is that you could combine the supports and resistance with, for example, a 2-bar, a 3-bar reversal down, for example, okay, with a warning, for example. So if you were to do that, well, now we only have one, of course, I've been more picky, but if we look at Merck, so we are talking about this one is a book example, to be honest. Nice. So if you have a speed bump here, so notice how not only price in the last candle has reacted to the speed bump, but on top of that, you are having this reversal signal, additional reversal signal based on price action. So now not only you have the speed bump, but price action is telling you, hey, this market is trying to go lower, right? So maybe a bit more evidence. Of course, now you are outside the speed bump because of that. So you get maybe a little bit of a worse price, but you get more evidence. So again, if you are more conservative, this is something that you may like better compared to simply using the speed bump by itself. So you could actually combine reversal signals together. Remember, the first set of reversal signals had to do with price action, where the bottom two have to do with the price location. Okay, what's the price? Okay, is it likely going to learn or not based on the price itself? Okay, instead of has it started to move in that direction already? Okay, cool. Well, hopefully this is understood. I'm going to take a sip of water. I'd love if you can get some confirmation from you guys on the chat box. Just a quick okay will do if you are okay with that. If you have questions, this is the time before I move into the next type of scans. Okay. So I'll be looking at the chat box instead something new comes in. Okay, so far it seems all is good. So next set of scans is what is called here as DT technical scans and options. Okay, so these are scans which are also very interesting. Thank you so much, Mark. These are scans which are very interesting because here we are combining options data with underlying data with an attempt of being very pragmatic. Okay. Again, these are some of the very few scans which, even though if you were not to select filtering conditions, like for example, strength or things like that, okay, or options filters when it comes to liquidity or price and things like that, or implied volatility levels, or options expensive or cheap or things of that sort, even though you may not be selecting anything from there, with those DT technical scans, actually some of that work is being done. For example, if I select a scan for potential candidates to do bull put, not only this list will be representing stocks that potentially are more likely going to go higher than lower based on technicals. So there is technical analysis built in the scan. On top of that, because it's bull put, and bull put means that you are going to be a seller of options, that scan is also looking for options that are fairly expensive. Okay, fairly expensive. Therefore, when you sell them, you get, fair levels of premium that make the trade to make sense. For example, if I look at you, okay, so that market is, somehow producing some sort of a price action that is suggesting something bullish is maybe likely or ready to happen. And on top of that, if we were to look at study volatility comparison, and we were to look at what's the implied volatility, for example, so you would also see that those options are not cheap. Okay, we're talking about 98% implied volatility. That is not cheap options. So selling premium there may make sense. Okay, so this is the nature behind those scans, which of course you can also add additional filtering conditions, no need to say, and make this even better. But there is already that built in. Notice what happens when I move from a bull put, which is bullish, but where you sell options, to bull call. Notice how, for example, you goes away from the list, and now we have other type of stocks, for example, Matrix service company, where now notice how implied volatility, it's still pointing at 152, which is definitely not a low level of implied volatility, but compared to its range, the top of the range here was 281, so 150, you could say it's low, right? So those are affordable options in a context of a market price, market behavior that suggests something bullish is about to happen. Again, looking at how overbought, oversold, again, there are multiple technicals built in the scanners, which is kind of, concentrating a lot of information in one single result. So those are very pragmatic scans that could make your life easier. But typically those scans, precisely because they have multiple things built in, they may feel, if you are an advanced options trader or an advanced trader in general, those scans may make you feel that, it's not picky enough for you, if you wish, because again, the price to pay for simplicity or pragmatism in this case is that, you have little control over it, and therefore may not be fully aligned with your trading plan. And while it's very useful, it may not work for you. Okay, so again, later you will see we have top option scans, advanced option scans. So we're going to be able to do many more things that are way more specific later in a moment, but just keep in mind that those scans, while being very generic, they are indeed useful, okay? Then we also have cover call potential candidates. So again, we are looking at options with a certain level of premium, also somehow of a bullish scenario, because when you do cover calls, you do want the stock to go higher. Okay? At the same time, you don't want the stock to be moving higher too fast. So ideally, those cover calls expire so you can sell more calls, sell new calls, and keep selling calls. So this is what this particular type of filter is looking for, but I'm not going to show it because later we're going to talk about cover calls in a moment, and those are going to be way more advanced and powerful. So I'm going to focus on those if you don't mind. And also the short-term bullish and the short-term bearish potential candidates, it's basically the same thing that we had above, but without taking into consideration the implied volatility, and therefore I'm not going to look into them either because it's kind of the same, okay? So let's talk about cover calls, okay? And when I talk about cover calls, actually I want to talk about two things. This is a very important conversation to have, actually, okay? Because I guess that all options traders, even if you are a basic options trader that started trading options not too long ago, and the way you learn is by, I don't know, I'm just going to make this up, buying an options book, well, probably your first intention is to do cover calls because it's something that everybody does. And especially if you're coming from the world of trading stocks and this is your baby steps into options, typically you end up doing cover calls, okay? And nothing wrong with this, by the way, okay? Many times in life, simple, it's the way to do things, okay? So nothing wrong with this. But having said that, and this is the time where we combine learning about top with also adding a little bit of lecture time. So listen carefully here, because I need to talk about options equivalency, okay? So what is options equivalency? And why am I talking about it? Well, you will see. I'm going to start with why I'm talking about it, if you don't mind. So I'm talking about it because doing cover calls is the same as selling puts. And you're going to be like, what? Okay, so let me talk about equivalency and you will understand. But keep that in mind for a moment and bear with me if you don't understand why. Doing cover calls is the same as selling puts. Therefore, our matrix that helps us to look for cover calls right here is also a fantastic tool to find very good opportunities to sell puts. Okay? Anyway, you'll see that and you'll see what I mean in a moment. So this is why I'm gonna do a mini lesson in options equivalency. So then you understand better why this could also be used to sell puts. So take a look. Buying a stock, okay? So being long the stock plus is long, that's the same as buying a call and selling a put together at the same time. It's the same. Another way to think about it, if this is not clear to you, that should be clear to everybody. But if it's not clear to you, another way to think about it, okay, another way to think about it is that if I buy a call, that is the same as buying the stock and buy a put. Okay? If I move the put to the other side of the equation, the minus sign becomes plus, isn't it? Basic math. And I end up with a below formula. Okay? And hopefully, if the above formula is not clear, the second formula proves to you that's true. Why? Because if you buy the stock, what's the most you can lose? Is the value for the stock. But what if you buy the stock and you buy a put? Well, what's the most you can lose? Well, the most you can lose is the premium paid for the put. Right? Why? Because if the stock falls, the put protects you against the fall. So you can exercise the put right and get out at the current price, and you never lost anything on the stock. The only thing you lost is what you paid for the put, which is the extrinsic value portion of the put, which has to be the same in the call side unless there is an arbitrage opportunity. So buying the call equals buying the call and buying the put. Therefore, buying the stock is buying the call and selling the put, which in prior sessions with Josip, we talked about synthetics, which that's a synthetic. Okay, so I believe this should be clear. I don't want to make it too long, but if you need me to re-explain, let me know. Meantime, I will assume you're with me. If you're not with me, again, I have no problem to erase everything on the screen and start from zero. Let me know if that's the case. But if you are with me, then Bear with me. Buying the stock and selling a call, that's your cover call. Well, then that's equal to selling the put. So in other words, doing the cover calls equals selling puts. Same thing. Okay. Now, uh, one of the reasons why this is often confusing is because the majority of put sellers in the world, what they do is that they look at the charts and they're like, okay, there is a nice UFO down here at this price. Let's say this price is 50. So what do? You sell the 50 put, hoping to get the stock put to you at 50, while the stock is currently trading at, let's say, 55. So the current stock is trading at 55. You sell the 50 put, which is below price, and you hope for the stock to drop, and then you get the stock put to you at this lower price. Okay. Now, when you do the cover call, typically that's not what people do. When you do a cover call, what you do is the opposite. What traders normally do is that they own the stock at the current price, which is 55. Now they turn around and they look at UFOs above price, okay? Let's say 60, and what they do is that they sell the 60 call, which the 60 call is out of the money. Just like earlier, when I wrote the 50 put, the 50 put was also out of the money. Well, guess what? In the formula that I just described here, buying the stock and selling the 60 call is equal selling a put, but not selling the 50 put. It's equal to selling the 60 put, which is in the money. Okay, which is not a usual thing to do among options traders. Options traders that sell puts, typically they sell the out of the money puts because they are hoping for the stock to go down and get the stock put to you. But that's not equivalent to a cover call. In a cover call, you own the stock. You don't start with, I wish the stock is put to me at a lower price. That's not the starting point. When you do a cover call, the starting point is I already own the stock at current price. Now I'm going to sell a call against. And if you sell the 60 call, therefore, the equivalency is you not owning stock and selling the 60 put instead. Are you guys with me on that? Can you please confirm what I just said? In other words, I'm going to write it down while you guys confirm. Own stock and sell 60 call equals not owning stock and sell the 60 put. Make it. Yeah? So no stock. Everybody with me on this? Yes, Jeff. I'm happy. I'm happy to see that I'm opening your eyes there to something that is very useful. Most people buy shares, tie up all the capital needed to own the shares. For the people outside of the US, which is your case, Jeff, which is my case, if you own shares of stock and you get paid dividends, which is not a bad thing, now you get tax withholdings for the dividends being received because we happen to be outside of the US. Right? In the US, the US traders need to pay capital gains tax, which is a different story. Like in countries like in Singapore, for example, there is no capital gains. So you don't pay taxes on the dividends, but you get tax withholding from the US. So you get 30% less of the dividend. Right? So guess what? Instead of owning the stock and selling calls, just sell the in the money put. The dividends are built in the put. So you will collect that as the option expires. But it's not technically a dividend. So you don't pay taxes. Let me rephrase it. You don't get tax withholding for that portion of money. And on top of that, instead of 2 trades and pay 2 commissions, you just did 1 trade, which is sell a put. And on top of that, you get less margin requirement because selling a put requires less capital compared to buying the stock and owning the stock. Okay. Also, if you buy the stock and you own the stock, on margin, now you need to pay interest to your broker for the margin used. Okay, so again, many benefits. Again, we could have a lesson on that another day, but I'm happy that you got the point. Okay, you got the point of this very important realization. So now coming back to the matrix, what can we scan for here? Well, we can scan for cover calls, which is the same thing as saying you are scanning for puts. Now you know, and you can look at four different measurements, which is the static return on investment, the return on investment annualized, the what if you get called away return on investment, and the what if you get called away annualized return on investment. So let's start with our static ROI so I can explain what's that and we understand better what to scan for depending on your trading plan, your trading style, and what you're looking for. So if I scan for static ROI, notice that I have been given and it's sorted based on performance. We get a column here which is static ROI, and we get greater figures on the top, lesser figures on the bottom. So it's sorted based on that. Why? Because we selected that, static ROI. So what is static ROI? Well, static ROI means that if we look at the stock SAVA and you look at a specific 20 call, okay, which the 20 call is slightly above price. The current price is 19.24, so it's slightly out of the money, slightly above price. So what happened to that call? Well, that call it's paying you $11. That's the last trading price for that call. So let's take a look. If we open an option chain, let's go ahead and make this yellow and float it. Okay, I'll make this a bit smaller. Okay, so that way I can keep the chart to be full size. Here we go. So if we look at SAVA, okay, that stock, okay, that stock has an option chain where if we look at, where is the matrix, January 19, 2024, January 19, 2024, okay, and we look at, not at the money, but we look at the 20 strike. So that last traded price was $11 for the 20 call. That's the last traded price. So going back to the matrix, and now I'm going to get a calculator. So knowing that the last traded price was $11, and knowing that the current price of the stock is 19.24, so $11, and knowing that the last traded price is 19.24, so what is the return on investment for that? It's 57%. Okay, so here's where that 57% comes from. Is the static ROI. Now, of course, that implies that you need to wait until 2024 to realize that, okay, which may not be your plan. How can you change that? Very simple. You can get into your option scans and be like, wait a moment. I only want options that expire in maximum 150 days. Okay, I only want options that expire in maximum 90 days, whatever that is. And if you were to scan based on that, so now, of course, that opportunity is going to go away. But now all the options you got have much shorter expiration date. Okay, and you will have other types of ROI, obviously, which we'll talk about in a moment, which could actually be better. We'll see that in a moment. But again, of course, depending on what you are filtering for, static ROI, and depending if you filter further or not, then the results will change. Okay, so just keep that in mind. Now, going back to where I was, SAVA is giving me that 57% of static ROI, which now you know where it's coming from, is the premium collected out of what is costing me to own the stock. Okay, so you can buy the stock and sell the call and you make 57%, or you can just sell, instead of the 20 call, sell the 20 put. Okay, and you're gonna get the same ROI. Now, to me, that is not the most interesting parameter for the scan, even though nothing wrong with it. But to me, looking at it from an annualized point of view may be more efficient, because fair enough that you're going to make 57%, but it's going to take you all the way to 24 to make 27%. So that may not be that good. If you annualize it, okay, probably SAVA is not going to be in the list, okay, Now we get Veru, which is giving you an annualized rate of return of 565, which is only 10% of a static ROI. But again, you get that 10% from now until May 20, which that's 5 days from now. Okay, so now, is this a trade for you to take? Well, again, it depends on your trading plan. You look at Veru in the chart, is going up, it's currently trading at 13. What this is telling you is that you would be selling the 13.5 call. Okay, you would collect 1.47, and that is again 10% in just a few days, which annualized is 500%. So amazing. Okay, but of course you are selling an option which is very close to price with very little time to expiration. So maybe your probability of being called away is very high, and maybe that's very fine with you. Maybe you are trying to do cover calls and not to be called away. Again, that would really much depend on your trading plan. But in any case, you can see here how you can make it so much more active and potentially get values which are way juicier compared to that 57%, which annualized is much less, okay, that we had before. Now, to me, while these two scans are very interesting, the if call version of the scans is probably, maybe it's because I am a conservative trader. Conservative doesn't mean I'm not active, but what I mean by that is I care about risk. So that's my definition of conservative in my very personal specific case, and therefore, if being called away is a possibility, I want to assess that. So being called away, okay, it's a filtering condition that is very interesting to me. And in this case, for example, with SAVA, you got 61.3%. We still got SAVA there. But what does it mean to be called away? Well, to be called away means that not only you're going to make money on the premium, but you will also make some money on price movement. So, for example, the current price of that stock is 1924, as we saw before. If you sell the 20 call, okay, that means that if you're called away at 20. That means that you're going to make 76 cents. So that means that apart from making $11 on premium, as we saw before, you will make additional 76 cents, making a total of profit of 11.76, which out of the current value needed use in your account to be able to be in the trade, which is the cost of the stock. Sorry for my hiccup. That would give you a 61 point something return on investment. Okay. Again, you see a little bit of a difference in the decimal places. It has to do with decimals and stuff like that. But basically, you can see is what it is. And so you can see how this is calculated now. Okay. Now, what if we look at the annualized if called? Okay. So if called away, return on investment annualized. Okay. So now we are getting 800% here. Okay. Still Veru. So how is that calculated? Well, similar, but very different. So in this case, we are looking at the current price of the stock is 13. If you are called away, you're going to be called away at 13.5, which is the call selected. So you are making 50 cents. So on top of 50 cents, you're going to be paid $1.47 for the option. So if you get paid $1.47 plus 50 cents extra by being called away, that's a total profit on the trade of $1.97. And that is out of a stock which is currently trading at $13, meaning that you need $13 in your account to take the trade if you take the trade. So how much is that? 15 plus, which is sorry, not here. 15 plus is what you get here. Okay. Again, there is different decimal places because of what I said. Okay. But you got 15 plus. Now, how do you get to 800%? Well, if you look at May 20 expiration on Veru, we are dealing with 5 days to expiration, right? So if you're going to make that in 5 days, but then you're going to analyze it, meaning that you're going to anticipate that you are making that every 5 days for a whole year. So the way to do the math would be to multiply this times 365 and divide it by 5. So that is going to give you an annualized. What did I just do there? Give me a second. I didn't do this right. Yeah, I did the opposite. Sorry, guys. Let me do this again. Let me come to the calculator. Let's do the math again. So we are talking about 15.5, right? So I'm going to do this in 5 days. Okay. So this basically per day. If I take this divided by 5, this is the per day performance. And if I multiply this times 365, now I did it right, I'm going to get like 1,000+% performance, which is not 800, but again, it's because I got the decimal places wrong. And it's many, many days. And so the difference with the decimal places times many, many days is the difference between 800 to 1,000+%. Okay, so sorry about that. The matrix is doing the calculation more accurate as well, because I am also basing the calculation based on the last, where the matrix is also looking at the midpoint between the bid and the ask and things like that. Okay, so bottom line, the matrix is more precise than what I'm doing with the calculator. It's also taking into consideration some of the holidays and things like that. So again, is more accurate. But the bottom line is that now not only you have a measurement of the performance based on what you get and that's it, you also get a measurement based on the performance through time, which is very relevant to me. This to me is more relevant than the performance by itself, because I mean the clear case was earlier with the other scan, right? Where let me get it back, where you got SAVA, right? Which is giving you this number of 61%, which seems very nice. But then if you analyze it, it's only 36% because you need to wait all the way to 2024. So then, in other words, doing it annualized, it's probably a more intelligent way or more efficient way to approach it, even though different trading plans may have different requirements. Okay. So now let's say you are shooting for this approach, but May 20 is too short, and your trading style, your trading plan involves again, more days to expression, things like that. So you could set a minimum of maybe a minimum 1 month, minimum 30 days, maximum, no maximum. So let's go ahead and see what happens now. So if you were to do that, now you end up with CNVA, okay, which is giving you a static ROI of 23%. This is using June 24, 2024, and that's 200% return. Okay, so maybe now you look at the chart and CNVA and CVNA. Sorry, CVNA. Here we go. And now maybe you have a trading setup here, which is valid, giving your methodology, whatever. You could combine that in many different ways, and that's how you would scan for it. Okay, so hopefully this makes sense. Again, I'm gonna repeat it one last time before I go for the next scanner, because again, my intention is to complete the list today. So remember, when you scan for those 4 guys, even though you have the pros and the cons, which I just discussed a minute ago, the results you get are just as valid for you to do cover calls than, let's pretend you don't have the stock, you just sell in the money puts. Okay, that's it. Okay, now next one in the list, Mark. So if one sells very 13.5 put, one will get the same return. Yes, the difference would be maybe you have a bit less, a bit more liquidity on the call side or the put side, and you get a bit of slippage, and that may give you a bit less or a bit more. So there may be certain differences because the world is not perfect and the financial markets got a little bit of wiggle room here and there, but in the theory world, yes, it's exactly the same. Okay, cool. We should do some lesson someday about that. Top option scan. Okay, so this is another pragmatic, I would say, section where here you're looking for anomalies based on how much options have gained, how much options have lost, how much volume is there. Again, ranked, meaning that you're looking for anomalies. So top point options gainer, right? So this is going to show you options contracts. Let me contract this. Options contracts where the performance is crazy. Okay, so this is Amazon, and here's the last price of this option, and this is the net change. So the net change is $1,000 plus on a 3,000 something. So it's a huge, massive increment. This is what we're looking here: gainers or losses. Again, personally, not a fan of this. But again, if you're looking for options anomalies and things of that sort, this could be a very good indicator of finding options contracts which are receiving huge quantity of trading, especially if you were to combine gainers or losers together with volume. Okay, now for example, you can see here you got Apple, okay, that has an average volume of 4,000 contracts, and that particular 150 call that expires on May 20 got a trading volume of 95,000 contracts in one day, which is way past 4,000, which is the average. So something may be going on there, right? So you could do combinations, trying to spot strike prices where something may be happening, which is very relevant. And this, to be honest, could be quite useful combined with a volume map. So if you identify a very, very strong volume combined with options gainers, for example, so you have a huge increase of price in an options strike and a huge increase of volume, and then you look at the open interest on the volume map, and you identify that strike with also a very high open interest, and then you look at the chart and you have a UFO there. So I would say it would make a lot of sense, for example, to sell puts there and be willing to get the stock put to you at that price point. Okay, you may need to replay the recording to listen carefully to what I said. But again, this could be very unique ways on how to filter for unique market opportunities. The downside of this is that when this happens, it's not too often. And on top of that, if it happens, it may be a bit quick. So you need to be fast. You need to be one of those traders who spend time scanning the markets multiple times a day, which again may or may not be your trading style. Okay. So let's continue with the next element in the list here. Stocks with top options volume. Okay, so now instead of looking at volume for one options contract, one strike, we are looking at major amount of volume or major interest rate coming down on a specific stock. Okay, on a specific stock, which may be representative of maybe you're looking at sector rotation, for example. You're looking at a sector that is rotating, and then within the sector, you're looking at certain stock that is supposed to rotate, and now you see price action happening on the stock rotating, right? And you could scan for all of these on, using the rotation tool here, the group tool, which we'll cover another day. Okay, but on top of that, now you are scanning, right? And next thing you know, you see that stock comes with plenty of volume, maybe call volume only, okay? Overall across the option chain, across multiple expiration dates and strikes. So that would be a good indicator that tells you that, look, the derivative markets are, basically backing up that idea, okay? So again, you can do a lot of things here, very original. I think the list is quite self-explanatory, so I won't spend too much time, but certainly you could do a lot of scanning, which is very original, looking for very unique opportunities, and you can spot them, okay? Because scanning for this manually is just impossible, okay? Another thing you could do here, it's to look for evidence in the form of historic volatility, which is something that we don't look at it too often. But for example, you can look at, here's another idea, a percent increase of the 20-day historic volatility. So let me show you how this looks like on the chart. So for example, if you look at Las Vegas Sand, to pick one, which is a known stock. So if you look at the chart of Las Vegas Sand, look at what's happening. Major move, 15% increment in the last day. That's way more than the implied volatility. Okay. So again, let's say you are scanning for some stock that belongs to some sector, but you want to wait for the evidence that the stock is pushing hard. You are looking for a change of climate, things of that sort, where scanning with this type of indicator, in this case, historic volatility, could be very useful to find stocks that are providing the evidence I just mentioned, where maybe you are doing your analysis over the weekend, you are looking at candlestick patterns, you are looking at group rotation, you are looking at, auto climate, which is, very, very, very hopeful, expecting it to change and become early in a different direction. Well, you can now, during the week, in a daily basis, scan for this type of increase in historic volatility, and then you would get that indication confirming that, this is happening now. Let's go ahead and plan the trade. Okay, this could be one way for you to save time. Again, in the context of, I'm just giving you an example, a trader who looks for trades over the weekend and then look for the confirmation during the weekdays. Another type of list which is very useful is when we get now into the advanced ones. And to be honest, the advanced one, even though it's very long, um, if that's okay with you, I will spend very little time here because this is the one I use most of the time, all the time, when we do the live sessions, right? So probably you are familiar with a lot of it, okay? Now, I will point at the fact that the top positive and negative CAV spread is a very relevant metric to me. Okay, top positive and negative CIV spread. Why? Because top positive CIV spread or top negative CIV spread is basically giving us indications of stocks where in the derivative markets, in the options markets, there is bullishness building up, or I should say bullishness happening. So if I show the implied volatility of the calls and the puts today without a smoothing, okay, so you will see how the blue or the gray is above each other. So you are getting measurements of a stock getting bearish when the gray is above the blue, or a stock becoming bullish when the blue is above the gray. And this is telling you that in the options markets, that bullish or bearish sentiment is building up, which potentially often then translates in stock price movement, like it's happening here. Not always the case, but definitely it's another ally when putting a trade together. Okay, so this is one of the tools I use very, very often when I'm looking at this type of scans. Implied volatility mean greater than 80% of the range or lesser than 20% of the range is often what we look for when looking for expensive or cheap options, combined with implied volatility mean minus historic above 2 standard deviation, that's expensive options. Implied volatility mean minus historic below 2 standard deviations, that's cheap options. Or top percent increase in the implied volatility mean in the last 5 days, that's expensive options. Or top decrease in the implied volatility mean in the last 5 days, that's cheap options. Okay, all of those are combinations I use all the time. So if that's okay, I won't comment because it's, I guess, well known in the community. The ones I don't use too often, though, which are pretty interesting, is the Fibonacci ratios. Okay, those are very nice because basically they are giving you list of stocks that are trading at a relevant price point. For example, if I look at Fibonacci ratio long, okay, and you have daily and weekly long and short. So, for example, if we look at CHRW, for example, so if we look at that stock, okay, that stock is moving down, but most importantly, is hitting a fib ratio. Again, there are many ways on how to draw fibs, okay, but again, if you go from pivot to pivot, okay, well, guess what? We are right there where our ratio is, okay. Again, to me, what's more powerful is to scan for this and then look up for the confluence with the UFOs, okay. That's even more powerful. And other parameters. In this case, for example, I will not be too happy because the implied volatility for the puts is above the calls, gray above the blue. It's bearish sentiment in the options arena, so I wouldn't be too happy. But again, this is a possibility for you to scan for opportunities to add more relevance to the trade setups that you have. So this is built in, and this is one that I don't use too often because also very often you end up with fewer opportunities. So, but again, if you are picky, that could be a good one, and also very good if you are looking for the weekly ones. Okay, very, very good if you're looking for the weekly ones, because especially in markets like now, when the market has dropped deeper and deeper and deeper, okay, so you potentially could find opportunities which are very nice. For example, here we got Walmart. Okay, so Walmart has been dropping for longer because again it's a weekly time frame, and again if you calculate from this pivot to this pivot, okay, so I guess it's being calculated from this one to this one. Here we go. So we are hitting this particular Fibonacci. Okay, so that's where we're at. So it's relevant. Again, there is no UFO, at least in this time frame, so I wouldn't be so happy to take the trade based on my trading plan, but certainly the indication is there, and that's the scanning designed to save you time. Okay. What else do we have? We also have the advanced scan, where one option is stocks with overpriced options or stocks with underpriced options. To be honest, this is exactly the same as the one with CIV mean minus historic volatility above 2 standard deviation. The only difference is that above 2 standard deviation is an extreme condition of expensive, of extreme condition to be cheap, where this advanced scan with overpriced or underpriced simply means implied is above historic or implied is below historic, and therefore is not necessarily an extreme condition. It's just overpriced or underpriced, even if it's only overpriced by a little bit or only overpriced by a little bit, is going to show. So again, I would be less keen to use this one because in my trading plan, I prefer extreme conditions. But again, maybe in your trading plan, you are not going for extreme, and then that would be the scan for you to use. Okay. A scanner that is very interesting here is skews with smiles and fronts. Okay. And this is looking at the front months. So for example, let's say we are looking to sell bull put spreads below price, take the premium of those bull put spreads, and then turn around and buy calls above, right? How would you want this to be? Well, you would want the puts, okay? Especially if the puts are close to price, you would want to be more expensive, and you would want the calls to be cheaper. So a frown looks like that, meaning the calls above price are cheaper. A smile looks like this, meaning the puts below price are more expensive. Okay, so I would love to find puts that are smiling and calls that are frowning. If I was to do that, I would select, let me do this right. So I want smile on the put, and I want frown on the call. And by doing that, you get this list, okay? And now, for example, maybe you're looking at Chevron, okay? And again, I'll do this fairly quickly because we are surpassing the time for the session now. I'm just noticing this. So if we look at Chevron, CVX, okay, and we look at June 17, I'll do 9, hold and put both, okay? So notice how the puts below price are expensive and the calls are cheaper. And the calls above price are cheaper, and even in this section, it's a bit of a frown, okay, a bit of a frown, and then it's smiling, okay? But anyway, so if this is the current price and you buy calls here, you kind of buy calls cheap. Where if this is the put price, and even if you were to sell puts, let's say at 160, okay, notice how from current price to 160, you benefit from the smile, meaning higher implied volatility, meaning higher premium. So those puts are going to be more expensive while those calls are going to be cheaper. And therefore, potentially, you can build positions with a price advantage, with a higher delta value because your call is closer to price, and your call is closer to price for less price because of the frown. Okay, so those are scanning options that you have available at your fingertips. Very powerful stuff, really, for you to practice and enjoy and find very unique trades at times. Okay, because frown and smiles change through time. Okay, sometimes it's often given certain price anomalies. Just you saw earlier an example where there were like thousands of contracts traded as a specific strike with a huge, crazy amount of unlikely volume. Well, guess what? That option price is impacted by that crazy volume. So that may now generate a smile or a frown, depending if it's buy or sell volume. And again, finding those opportunities could be an advantage for us as traders. Okay, and that's where we have these smiles and frowns. And finally, I'm going to move into the last one, which is the volume map. Okay, where first you can look at current or next. So current, meaning the front month or the next month, both for the call or the put, current or next. Okay, put below, call above, current month, front month, or next month. And then you can look for the imbalance for the calls to be greater than 1.5 or the imbalance for the calls to be greater than 1.5. I mean, the imbalance is either you are above the you are in balance or not. That's maybe an easier way to think about it. So imbalance or not in the current month or the next month for either the put or the call side. So, like, let's say you are looking to be bullish. Okay, like earlier we looked at reversal signals, for example, 3-bar reversal up. Okay, but you want that reversal up based on the candlesticks to be proven as well based on the options data. So maybe you will want to look for calls with an imbalance. Okay, and if that was to be the case, so now those stocks, for example, we have Facebook, okay, or Meta. So when we look at Meta, there is, that chart pattern of 3 up, so it's moving up. Okay, but on top of that, if you were to look at the volume map, so your imbalance would be at least 1.5 or more on the front month. Okay, maybe I can just put it here to conclude the session. Okay, so front month is June 17, I believe. Yes. Is it June 17? Wait a moment. No, it's not June 17. It's May 20. What am I saying? Sorry for that, guys. It's May 20, of course. The third Friday of the month is May 20. So we are talking about 2.1, which is more than 225. It's blue color on the favor of the calls. So you have this particular benefit, right? Together with, the 3-bar reversal up. So this could be one way for you to look at confirmations as well, or basically maybe you are looking for trade setups where you have that in your favor before you trade in a specific direction, either using the current month, or maybe you are looking at the next month. Especially in this case, May 20 is really around the corner right now. So maybe you're looking at the next, which is going to be June 20, and now you're looking at other stocks. Okay, so Facebook is not going to be in the list now, as we saw. So, but Autodesk may be there. Okay, and now you have your chart pattern. Okay, where you have that particular price action in place. Very good. So I believe we've covered everything when it comes to all the various scanning possibilities here with the matrix. Of course, the possibilities are really truly infinite, because now you can combine things with things and add filtering conditions on top of it. And when you get a result, you can save it as a list and then use the list for the next scan, where now you change the scan 1, 2, 3, and everything else. So you can actually have really customized results that line up exactly perfectly with your trading plans and keep you absolutely in line with what you want to do when you trade. The challenge is you have so many tools that it's often confusing to start using the matrix if you have never used it before, and therefore my suggestion would be just give yourself time, take it easy. You don't need to make it too complicated. It's good that you have many choices, but take it easy, because then you may fall into this spiral where you are just testing, but you're not trading. Okay, so keep it simple, I would say. And if you need help, for sure, send questions to the question page, or let me know in the next top session, and more than happy to go over your questions. Maybe from now until, I believe we'll meet again. Our next top session, I believe, will be in 2 weeks from now, if I'm not mistaken. So when we meet again in 2 weeks, you got 2 weeks to practice, and maybe you come up with many questions for me. So I'll be happy to discuss that as we get into other topics. Okay. In the meantime, as always, I will say thank you very much for joining me. As always, I'm always very thankful, and I love it when we get together here to talk about trading and the market and technology. We all love it all. So it's always very happy times. But as always, and I mentioned that before, I'm always sending you a special thank you when it's on Sunday, because obviously you proved yourself as a real market lover by meeting with me on the Sundays. And I'm sure if you're watching this recorded, because maybe you have family matters, which indeed are more important, and you cannot watch us live, okay? And to you is just as important that for the other attendees. But in any case, I'll say super thank you for the ones of you attending live, because definitely that makes my day, and it's very special of you, and I'm very grateful. So see you on the next one. You guys keep up the good work, and hopefully that was another useful session for you guys. Hopefully beyond useful, it was powerful. And on top of that, you had fun. That was my goal. Hopefully, I accomplished that. You guys take care. Thank you for the nice comments, Jeff, Mark. Thank you for uh, calling the matrix awesome. I do believe it's often as awesome because it keeps you in check in a way, right? Because in a way, it's designed to save you time, but in another way, it's really forcing you to trade the way you should based on your trading plan. And instead of looking at 9,000 stocks and you don't know where to start, next thing you know, you are just given a list, and that's what you're going to trade today. And that keeps you, very much in a mechanical place where you are going to be having this consistent action, which is supposed to produce consistent results. Take care, everybody. See you soon. Bye bye.